So our next panel is really on venture capital and the funding, the future of the online sports betting and iGaming industry. So we have a large panel. I've got a number of questions, so I'm going to try to just kick right into it and go down the line. And I think that we'll start just super big picture, which is obviously technology has really changed the way that sports are watched, how do you engage with it, whether it's on a phone, whether it's through sports betting. So maybe if we put it all together, give us each your kind of big picture framework for how you see the industry evolving over the next, we'll say, 5 years, so a little bit of a longer term time horizon, as we think about that convergence of technology, media, sports, betting, et cetera. Maybe I'll start on this side. It's a loaded question, go down that way. And you can also introduce yourself, although I think that people have your bios on the site as well.
Yeah, Dan Fetters from Acies. Pleasure to be here. Look, over the next 5 years, I guess I'll just take a pocket of where we're spending a lot of time, and you have to look no further than Europe or Australia in terms of the volume of wagers focused on micro markets and in play, and we think we're at the infancy of that in the U.S. Part of it is a knowledge issue with respect to the customer base, knowing that those options are available. Some is a technology issue, some is an integration issue, and we think that presents a huge opportunity over the next few years and where we think you're going to see a lot of the volume go.
Steve from Yolo Investments. I think most of our portfolio companies are actually outside of the U.S., so a lot of more mature and competitive marketplaces. I mean, what we clearly see is sports is more of a acquisition tool to iGaming and casino products. So I think a lot of the retention and community and customer experience are the things that we look for in terms of investments, that they have proper focus on. I think the most important thing for customers, getting your money in and getting it out when you win very quickly. So those are some of the things we try and look at in terms of the portfolio companies we look at. So.
Great. Hi, everyone. I'm Meredith McPherron, Drive by DraftKings. We're also a venture fund primarily focused on go-to-market in the U.S., seed stage and Series A primarily. We actually have a slightly broader investment kind of strategy and thesis on sports and gaming, media and the fan experience, and then also in human performance. So we actually see enormous opportunities really at the intersection of all those. Specifically, if I thought about my vision for the next 5 years, I mean, obviously we've seen just a incredible resiliency around sports in general, a rising tide around that's been critical, obviously, in the inflection of sports betting. Sports betting also a rising tide and incredibly important in terms of all of gambling, and I think the influence around that. Within sports betting, we see a couple big themes. Obviously, this day has been fantastic, by the way, some great panels led by you and others. But just the deepening personalization is just an incredible theme that we see across all of our investments, fueled by a lot of data and obviously the technology coming into the space with artificial intelligence and just data analytics overall. Social is a big theme that we look at, the social architecture and community that is derived from that, as well as importantly now with retention being such a key to driving profitability. And just sort of this coming in of artificial intelligence overall, we see that across all of our themes, but in particular in all of that personalization piece. So a few others, but I won't take more time.
Hey guys, Lloyd Danzig from Sharp Alpha Advisors. Son, thumbs up, thumbs down? Can't tell. I'll just talk loud until it's on. We see sports betting as a critical component of a larger arena that I like to refer to as competitive entertainment. There we go now. As competitive entertainment, which I think is a term that well encapsulates this umbrella under which a lot of psychographically similar consumer behaviors exist. Sports betting, casino, lottery, esports, skill-based wagering, Peloton races for money, you name it. And so I think that as operators seek to expand the TAM, figuring out how to cross-sell and cross-pollinate audiences into these adjacent revenue streams will be a major focus for operators in the coming years, as I believe will be the focus on the recreational entertainment-seeking customer, who may be lower volume but is higher margin. And so with that, I think, comes more instant gratification, things like micro-betting, same-game parlays and such, a lot more personalization, customization, to Meredith's point, and overall, a lot more avenues for customers who want to trade their money for utility, for experiences, for enjoyment. That is what excites me the most. I believe Dan mentioned Europe. A lot of lessons, I think, to be learned there. There are certainly some important cultural differences that make drawing lessons difficult, but ones that I do think are quite apropos, deal with responsible gaming and advertising. I think, in retrospect, what some of the European operators wish is that they had baked responsible gaming into the fabric of their infrastructure, and that they had perhaps curtailed some advertising efforts before they led to regulatory responses that ultimately have been so burdensome as to inhibit profitability. And so hoping that we can apply the American entrepreneurial spirit and ingenuity to the sector here, while also learning some of those lessons to help propel the durability and sustainability as compared to the European market.
Hey everyone, Dave and Egmond from Bettor Capital. I think the next 5 years in the industry are going to be defined by a shift from focus on marketing to focus on product. And that's why it's exciting to be invested in technology companies, or to be building a technology company servicing the online gambling industry. And my perspective is informed. I was a former executive at FanDuel. We competed head-to-head for a long time with DraftKings, and then when sports betting came to the fruition, a lot of companies joined us, and it was just a marketing war. And the next 5 to 10 years are going to be defined by customer retention. Do you have the best-in-class product? Do you have the new innovative feature? That's going to be what allows the winners to rise, and I think FanDuel today has one of the best products in the market, DraftKings as well, and that's why they're winning so much share in the marketplace. And so I think technology is going to continue to power the differentiation and drive market share gains, drive to profitability as marketing spend pullback happens and people invest more in the product.
So I heard a lot of P's: product parlays, payments, personalization, profits. But before we get into any of these themes, I also want to just talk about the current environment as we think about venture capital and the broader markets. And really, if you could talk to how you're counseling your portfolio companies, or how you're even thinking about investments differently based on what we've seen in the public market valuations, but also we've seen operationally folks changing where they're focusing their time. So maybe we'll start on the other end and work this way.
Yeah, I think we're advising portfolio companies to take as much cash as you can get. We don't know how deep a recession could be. Clearly, there's a pullback in the marketplace. If you don't need cash, extend your runway by finding ways to cut costs or grow revenue in new verticals, new ways. And if you need money, don't take a 6-month bridge, because you might be back in the same place in 6 months and things could only be worse. Take the pain, get it done, and keep building. That's the advice we're giving entrepreneurs, and I think sound in an environment where there's a lot of uncertainty, and you don't have to mark to market every day. So buy yourself 18, 24 months of runway, come out the other side with an improved value proposition and significant growth, and then you don't have to worry about where the public markets are on a daily, weekly, or monthly basis.
Yeah, I would echo all of that. Taking money when you can rather than when you need it also puts you in a position to raise from a position of strength rather than a position of weakness. This is probably the worst market in recent memory for companies raising from a position of weakness. It is quite difficult to do that. Parenthetically, spoke with a friend the other day who is a serial founder in the space. I think has built and sold 4 companies. He's on his 5th. He told me he has never had a company that has been doing so well, and yet it is also the hardest fundraising experience that he has had in the last 15, 20 years. And I think that is quite instructive, especially for less experienced founders out there. The math, I think, helps elucidate this as well. Perhaps 18 months ago, a company was able to raise at 20x last 12 months revenue. now maybe they can raise at no more than 10x last 12 months revenue. And so you need to double your revenues in order to at least just have a flat round. And similar dynamics and certainly lower revenue multiples are becoming quite common in the fundraising world. So agree with all of Dave's points and would just add on to that, although he did mention it as well. Getting to the point that you are so good at what you do that you cannot be ignored, that the proof is there, that you're not asking investors to take a bet on you, take a flyer on you, but that rather you have proved that you can do the thing you say you're going to do and people want you to do that thing. I think that is the position from which people want to be raising priced rounds going forward the next 18, 24 months.
Yeah, very well said. I would say a couple things for our current investments and then for new investments that we're looking at. For current, we definitely are also stretching everyone to try to get to that if they just, raised as long a runway as they can get to, which means cash preservation is the focus. I think within that, there's still opportunity, and we have to make sure that in that mode of cash preservation, we don't miss the opportunity. In fact, I think it can reveal itself in ways because people are more focused on execution, a little bit tighter in their planning around metrics, around innovation cycles, and just, lean and mean kind of thing. And so we, for new investments, like to see 24 months of runway right now in the raise, because I think for all the the raising interest rates, harder to raise, we don't want to try to enter into a deal with financing risk. I also think with respect to public market valuations, it's kind of what Lloyd was saying, when exit multiples are down, entry multiples are down. So it does put some pressure on and an opportunity for investors at lower entry points, but that's also something that founders have to take into consideration when thinking about raising in this environment. And the other thing I would just say is we lean in with our companies. These are times where it's tough, but this is the time when your capital partner also has to be your strategic partner and come in with your current investors to help bridge where you are doing fine, but you need more runway. So we try to have an aggressive reserve strategy to help our companies get to where they need to be.
I think our fund, general partners, the three of us are primarily entrepreneurs first, and then kind of financial investors. And from that perspective, I'm trying to reflect back. I don't think our comments have changed massively from how you build a business and run it, and then and now. Obviously, the capital environment is very different, but I feel like fundamentally, if you're building a good business and you can demonstrate that you know how you will make money eventually, then there is a flight to quality, actually. And I think we have about 6 or 7 portfolio companies outside that we're all proud of. They're all going to do good things. But I do push them in the direction of, not necessarily profitability, but demonstrating that you have scalable unit economics that is worth fueling and scaling at scale, right? And we also get involved into the ecosystem. So whether they're a supplier, operator, or something in between, we're able to have the data and the KPIs with our portfolio companies to see, is it working or are they just saying it's working? And then our decisions from there becomes much more simple.
Yeah, I don't want to draw a flag for piling on here because it's been said quite well by my venture partners, but I think you have a fiduciary obligation to your stakeholders. And I specifically say stakeholders, not shareholders, that one would say in a public company context, but it's your employees, it's your customers, it's your shareholders. And you've got to know that the funding environment is not conducive to go out and expect that you're going to have a successful raise in 6 months' time. So what are the action steps you can take today to ensure a successful raise, not only today, but in 18 months' time or 12 months' time, whenever that next capital need is there. And in 20 years of advising public and private companies across strategic and financial alternatives, I can't recall a time where a company has taken cash in and said, oh, I wish I wouldn't have taken as much. So that's our lens.
Sounds good. Maybe turning to sports betting then, there's been, as we said, there's different Ps that were talked about. Let's start with product. What comes after parlays as we move to more retention? What's going to drive the winners and losers of the online sports betting space? And maybe we'll start in the middle this time with Meredith, and then we can work out.
Yeah. On product, I think there's one thing I mentioned earlier was just some of the social feature set that's coming in, and I think that's not to be understated in my opinion as a feature. I actually think that when we look at the young people coming into the market, it's how they bet. It is about entertainment, and it is a competitive entertainment experience, but they're doing it together, watch parties, circling around, fading and tailing bets. It's such a big part of how they're engaging now with platforms that I expect that we're going to see more of that independently within the major books, outside of the major books, feeding into it. We're already seeing, I think, in some of these mature markets as we look across into Australia and to Europe, where how are the challenger brands getting in? And some of them are segmenting either by demographic, trying to enhance UI, which is really important in terms of ease of use, getting into the platform if you're a new bettor, but then also how that winds up folding into a better and a more social experience that then creates retention. So I think that's a big one. Obviously, we've talked about the same game parlays and that whole piece, live betting, micro betting, all of that, I think continues to have enormous runway and potential, and we're just getting started as latency issues get resolved with tech. I think we'll start to see different formats and modalities. So as we think about which a lot of speakers have talked about today, which is personalization and meeting the consumer where they're at. Will we be able to watch and bet at the same time on a single screen, or will it be also through a second screen, which it is today, or will it be all of those things? I think so. There's Uber and there's driving a car and there's cabs. There's multiple ways to get to one place. I think the same will be true here with product and content and distribution.
Yeah, I would. I feel so similarly. I'll have to just restate Meredith's points with my own words to make them seem original.
And they'll be better words.
Address one other thing with that, which is how much of this do you think is developed by the incumbents versus maybe new businesses, smaller businesses, entrants?
Great. Yeah, I'll try to layer that in. So absolutely agree that the next few years in sports betting product are focused on the entertainment-seeking, recreational user that tends to be maybe lower volume but higher margin, people who like micro bets, people who like same-game parlays, both of which, by the way, have predominantly been pioneered not by incumbents but by third-party B2B providers. I think that the social element is quite important, and you can look at that social behavior across other types of platforms. Forgive me if those of you saw my panel earlier this morning where I made a similar point, but if you're choosing just between Netflix and Hulu and all of your friends have Netflix, you're going to choose Netflix so you can talk about the same shows with them. If you're only downloading Instagram or TikTok and all of your friends have TikTok, you're going to choose TikTok so that you can share content with them. But right now, if you have FanDuel and I have DraftKings, we can generally place the same bet at the same odds and go to the bar and watch together. And the question is, how do you change that? How do you create a stickier, more socially focused experience? DraftKings has somewhat unceremoniously rolled out quite a robust set of social product offerings that are all available in New York. Everyone can check it out for yourself. But they have a social feed. You can see your friends' bets. You can tail their bets. You can fade their bets. You can join betting groups where you compare your P&L over a fixed period of time and message and things of that nature. There's an Australian startup that Tabcorp invested in. I don't know if John from Dabble is in here. I saw him walking around. If any of you are not familiar, they are almost an entirely feed-based B2C sportsbook. You open up the app, and what you see is all of your friends and celebrities and influencers who have placed generally multi-leg parlays, and you can tail those bets with one click. And the beauty is the types of customers who engage in that behavior tend to not be very price sensitive. They tend to be very high margin. And so I think trying to figure out how the operators integrate functionality like that, to Stephen's other question, that was an example where DraftKings has built the social functionality in-house and has rolled it out. And it'll be interesting to see if and at what point they decide to make that the front and center primary experience, or if it only exists as an ancillary experience. And then personalization, recommendation. I think our futures are largely, on a day-to-day basis, going to be guided by recommendation engines. Your smart alarm clock will figure out the right time to wake you up. Your smart closet will recommend the optimal outfit. Your smart refrigerator will give you the exact breakfast. And then your smart sportsbook or casino app will serve you the exact betting opportunity that you want the moment you interact, mitigating the decision fatigue and navigation and bet discovery that can peel away from some of the entertainment elements. So that was my attempt to restate all of Meredith's points as if they were my own and weave in some of Stephen's extra question as well.
I think live betting, micro betting are the two kind of hot terms in the industry. I would redefine it as breadth of markets, additional things you can bet on. And that's where operators are really trying to drive new innovation, whether it's new sports, player props, which resonate with the more casual fan who's used to fantasy and just wants to bet on is Tom Brady going to score a touchdown, new types of bets that drive a shorter attention span. We have a player prop company in our portfolio, and they're creating markets around first to 10 points in the NBA game, first to score in an NBA game, other types of derivative betting opportunities. And as I think about what operators are craving, they want enhanced retention, but they also want to increase LTV. So they want to give you more to do. They want to increase the frequency that which you can bet in a healthy and safe way. If you want to bet on the first to 10 points in an NBA game, take a break, go do something else, come back in, and then bet on the second half, the depths of markets that are available to you versus the traditional, hey, I'm just going to bet on the game and I have to sit there for 2.5 hours. People don't have the attention span and are craving different types of products. So I would describe breadth of markets as a way that innovation is going to happen in the market, and that even big companies like Flutter that have 1,000 people in risk and trading, the parent company of FanDuel, they still can't do it all themselves. And so that's where third parties can come in and provide something new and compelling to help achieve the goals of increasing LTV and better retention.
Yeah, I just want to thank Lloyd for marketing one of our investments there with Dabble, so thanks. But that's what I was going to say. In terms of the community aspect, I think it's critical because at its core, sports betting hasn't really evolved that much, except when it went online. Now you have the in-play micro element. So it's really how do you enhance that customer experience and branding when your competitors are all relatively offering the same thing. Similarly for iGaming as well, whether it's slots, whether it's baccarat, whether it's blackjack, it's pretty much the same thing. So how do you differentiate in how you treat your customers in a meaningful way? And those are the things we kind of try and look at. And then the other part is really UI and UX, and I do believe there's massive opportunity because, like, no offense to the old guys, but old guys ain't going to drive any UI, UX that's going to revolutionize or drive the opportunities for the next segments. So,
I think it's experiential entertainment. Lloyd called it competitive entertainment. It's, you know, in a different vehicle. I don't think anyone's using the 4-letter word called a SPAC anymore. We did a deal with Play Studios that takes social casino and offers real-world rewards for play, and we just believe there are opportunities like that. You listen to Evolution speak at an earlier panel today, and their view is that because of that social dynamic, live dealer is really perfect for the U.S. consumer. So, less relevant on the OSB side, but when we think about iGaming, how do you provide that stickiness of experience or stickiness of customer journey that relates to an experience beyond pushing a button and watching slot reels spin? So that's really where kind of we focus and where we think the opportunity lies.
So you both reference entertainment. I usually think of media companies when I think about entertainment. They've been involved in the space, but there's been mixed success. I guess, how do you think about the traditional media companies' role, and what's their incentive for becoming more involved potentially in the future? Maybe we'll start here and go down that direction.
There's always going to be a place for the traditional media companies. I think if you were in the boardrooms of each and every one, they're trying to figure out exactly how they can tap into this, 20, 30, 40 billion dollar market, and whether to do so in the form of partnerships or acquisitions. And I think the space is going to have the convergence of media and B2C sportsbook operator as a low-hanging fruit over time when people come to grips with the licensing paradigm being annoying and challenging and subjecting their board to more stringent disclosure obligations. But in the same vein, the value creation opportunity is so great in an environment where investment-grade companies are issuing 8% debt. And so your cost of capital is higher, and where can I deploy dollars and earn well in excess of my cost of capital? I think media companies will continue to look to this industry, given its hyper growth, as an avenue to deploy those dollars in a shareholder value accretive manner.
I think two aspects with media companies. Number one is brand. And the first hurdle any operator overcomes in this space is, if your customer win money, do they think you're going to pay it out? So they have that established advantage. The second part is cost per acquisition, because that's their distinct advantage being a media company. Their downside is really, can they build a new business? And this applies not just in this industry, but any big company trying to have their own venture arm within their own organization. So I think, to Dan's point, it's like build versus buy, and I think most cases, when they find the right, probably acquisition partner, that's when there'll be some success cases coming out of there. So, yeah.
I'll just add maybe a thought or two. First of all, it's a complete symbiotic relationship, right? Because media companies, they want to drive incremental revenue, and then the sports books want to try to get acquisition without, ideally, without having to, run their profits down, as we've seen. So, when they're together, and we can integrate the sports betting sort of into the conversation as part of the storytelling, part of the content, and they can work together, I think there's a great symbiotic relationship. And I think as sports betting continues to rise, the opportunity around the integration fully and more deeply into the conversation and into media makes a ton of sense. I view it as, and it's just my take, as more of a partnership versus a complete merger. But who knows? That's sort of yet to come.
Maybe as we go down the line, I'll say, what about video game companies? There's definitely overlap in the customer base. Do we see some blending there, or what does that look like? And we can come back this direction.
I think when we talk about traditional media companies, rights holders, and leagues, their primary source of benefit when it comes to sports betting is actually, in my view, less so from any specific commercial deal and more from the incremental revenue, engagement, retention that having a captive betting audience delivers. People who bet watch more games, they watch more minutes, they share more on social, etc. And it can be a bit harder to draw a tangible line and quantify that exact benefit, but I think in all likelihood it dwarfs or at least significantly exceeds the available revenue from a particular commercial deal. I think that from the operator side, for most operators, customer acquisition costs are their number one or two most expensive line item when it comes to expenses. And so the prospect of having a vertically integrated customer acquisition funnel and owning your own distribution, I think is quite attractive. Barstool, which certainly Dave can speak to, is probably the first major high-ticket attempt at that in the U.S., but we will see many others. Bettor, startup with Jake Paul, doing something on the integrated front. DraftKings has made investments at the corporate level into Meadowlark, I believe, and has looked at some other things in the space, so I think that is quite interesting. On the video game side, I don't see EA, Activision, Take-Two becoming operators themselves. I think the primary decision that they are all making at this juncture is how closely do we endorse betting? Are we going to open up our APIs and provide historical and in-game data feeds to facilitate all types of wagering, whether it's on our professional esports leagues and contests or peer-to-peer or player versus house, call it recreational video game wagering? I think the extent of integration that would be feasible in the near term, and it may not necessarily be feasible, we'll see, would be if there were a gaming publisher that was willing to allow betting to be integrated directly into the experience. You're playing Madden, you press pause, they give you odds on will you complete a first down on this next play. I think it is a bit of a difficult needle to thread, and even if it were threaded, it would not be EA taking the bets themselves. They would just perhaps supply the interoperability, and it would be a different group that is a licensed, regulated gaming operator. But even that, the biggest challenge, I think, for the video game companies is the ones we're mentioning, their revenues tend to dwarf what they could possibly earn from the betting space, and they have a young audience, and they're very protective of their brand and of the way that gambling and gambling-related activities could taint that. So it's a really interesting one and something I'm watching closely, because people who like to bet on sports and play video games almost certainly are looking for an activity that's a hybrid of the two. But getting the buy-in of the publishers, who, again, tend to have annual revenues that dwarf what they could possibly earn from betting, is a complicated matter.
Yeah, I was at Barstool Sports when we did a brand licensing deal and an investment with Penn National that ultimately led now Penn Entertainment, because they have transitioned to be an entertainment media business as well, bought the rest of the company. And to use a gambling vernacular, a media company has to go all in with the betting company to actually make it a successful partnership. Barstool Sports was significantly more impactful in the betting ecosystem than ESPN. Why is that? Well, because the hosts at Barstool are actually willing to promote the product, and you don't necessarily have to pay them extra to do that. On ESPN, if you want Scott Van Pelt to mention a betting company on SportsCenter, that'll be another $5 million, please. You don't have aligned incentives in a true partnership, and Mickey Mouse is scared to even mention betting in the game, let alone really dive deep to try to promote it and drive viewers to place bets. So there's a spectrum of how successful a media partnership can be, and that spectrum is defined by how all in will your media partner actually go to align interests and deliver for the operators in a compelling partnership structure.
I want to turn to iGaming, where we've hit a little bit of an air pocket in terms of legislation. Would love to just hear what you think comes next for iGaming specifically, and how the product may evolve on that side of the space as well.
Yeah, I'm happy to go first. I think industry insiders often say it's easy to get a sports team owner or a senator to support sports betting and promote dollars going to their favorite team and benefiting their local team. A little different on the casino side. And I think in particular, one of the challenges on iGaming, which I don't know the way to solve this, is if you go to a state, not every casino company is aligned. They don't all want it. Some worry their retail business will be modestly cannibalized, which that's what state data is showing. But if you're successful in online, or even have 1 or 2% online, it's accretive to the revenue of your business. But some local casinos, tribal operators, fear that they won't even be able to attain 1 or 2%, and it'll be net negative to them. And until you can get more consensus in states and get the legislators to be more supportive, it's very tough to get things passed in some of these traditional land-based casino states.
Yeah, I hear similar things from stakeholders, and in part it is a credit to the degree to which sports betting has lost any significant stigma and is considered more of an entertainment activity, whereas that stigma and the classification as iGaming as more of a vice very much still exists. As someone who is almost inherently a bit cynical, I tend to think there is just too much money left on the table, including for state tax revenues, if over the next 5 to 10 years many of these states cannot come to find a path to legalizing iGaming. But to build on Dave's points, particularly for politicians that have large conservative, evangelical, religious bases that are deeply opposed to gambling, it is a major sticking point that people are often opposed to, especially in election years. In the absence or even in the presence of legalized online casino, what I think we will see is attempts to make sports betting products more casino-like. The average recreational user, they actually don't want to often place a sports bet in which it is possible to have an edge, because they fear that they are not someone who has such an edge, and therefore they must be placing a stupid bet or a negative EV bet or whatnot. And so casino products, on the other hand, where for the most part in roulette, for example, the distribution of outcomes is uniform, and thus every bet is equally likely to win and has the same expected value, can be quite attractive. And so in parallel to attempts to lobby state regulators to legalize online casino, I think we will see a lot of efforts to make the sports betting experience more casino-like at the same time.
I don't have too much more to add, except for I think the conversation earlier today around sweepstakes being potentially a way in akin to fantasy before getting into sports betting might be not a way to solve certainly the regulatory issue, but a way to be able to bring some of the product and the experience out to other states under that cover.
Yeah, on the U.S. regulatory side, I don't have much to add. I think on the international aspect, on the more mature markets, what you see is sports is more of an acquisition tool, and I'm speaking from the perspective of probably 8-ish, whether it's English Premier League and Champions League type of sponsorship-related assets. And those are kind of CPA tools, branding tools, that ultimately results in higher margin, gross margin businesses in the iGaming aspect. Yeah, because it makes more money, players are losing more money, so there's that trade-off of protecting your customers and responsible gaming as well. So,
Didn't hear the earlier conversation that Meredith referenced on sweepstakes, but that's where we think there's tremendous opportunity. And it's flying under the proverbial radar today, but to take social casino dynamics of getting customers to play a game with no prospect of ever cashing out. So, how do you make that product entertaining and marrying that with an iCasino product that is heavily legislated and really in only 3 states of any consequence? We think there's a way to take that into 46, 47, 48 states, much like VGW has done with Chumbo, which I think is another portfolio company of you guys, I believe. But, we think that maybe not. But we think there's a huge opportunity there near term with the preservation of getting licensed in an iGaming context if, the prognosticators are wrong that we'll only see 3 to 4 more states over the next 3 to 5 years legalize iGaming.
So I think there was a common wisdom of not really knowing who is going to be the winners and losers necessarily, and so let's go after pick and shovels or find somebody who's servicing the entire industry, in a B2B versus maybe B2C. Where does that make sense? Where does that not make sense? Anybody?
I'm happy to go. I'm happy to go because we're a pick and shovel. That's the theme. We predominantly invest in B2B software companies in the online gambling sector. My view is you just look at the competitive landscape now in the largely public companies, they're all beating each other up. The number one company that's doing $3 billion of GGR is still not profitable on an annual basis, there's a lot of money that's going elsewhere from that $3 billion of revenue, a big piece to taxes, but a lot to suppliers and other ecosystem participants. And so we think that's a really interesting place to be long term, and think a lot of value is going to continue to accrete to the supply chain in online gambling.
I think B2B makes a ton of sense, particularly for user experiences for which the user does not benefit and maybe actually finds it undesirable for there to be differentiation. If you like to bet on desktop and you have to download a geolocation software in order to log on to DraftKings, and now you want to try out FanDuel, do you really care if it's the same or different geolocation software? You might actually prefer that it be the same because it makes things easier for you. And so certainly, I think without a doubt, when you think of KYC, AML, payments, geolocation, those are obvious areas where B2B is the right play. B2B companies tend to operate at a higher margin and therefore at higher revenue multiples. I think right now in the US, publicly traded B2B companies trade at 4.5 times forward revenue, whereas B2C companies trade an average of 2.5 times, and I think that's reflective of higher margins, of a more stable revenue streams, and of not having to suffer the regulatory burden and customer acquisition spending that B2C companies suffer from. On the other hand, part of the reason customer acquisition costs are so high is that the LTV is deemed to be quite high, and so it is B2C companies that actually own that end user, and a B2B company that only services the industry, in theory, can only grow as large as their percentage revenue share of the total pie. And so to summarize all of that, on average, I do think that B2B companies offer the best risk-adjusted return, particularly at the early stage. However, on an absolute basis, the largest outcomes are more likely to come in the B2C arena.
We do both. So we think there's opportunity. Both, D2C is really tough right now, obviously in the US because of the concentration in the market. But overall, I think talk to B2B, I think, we look at like, where's the category? Where's the arc of the category? And when we feel like there's, you have to take like major hit risk on, we don't know what's going to work in this rapidly evolving market, like in gaming and so forth, then oftentimes the platform plays that can be those picks and shovels for a broad array of those that may win or may not wind up being very attractive investments.
I think we're probably 60-40, B2B, B2C, and I think it's a synergistic relationship because I think the B2C gives us better insights operationally, KPI-wise, retention, margins and such on the B2B products, and makes us try and make better decisions on the investment basis and then follow on investment basis as well. So, but yeah.
And I would just add one other thing, sorry, out of turn. But some of the studios, for instance, that we invest in actually become then platforms. It's kind of like Fortnite to Epic. It's like this is the way they go. When they have an engine underneath that actually others can develop on. So sometimes you have to take that initial step with a great team and know that that's the trajectory they're on.
Yeah, we do both, and it helps us evaluate the TAM for both, for principally our B2B investments, and then I think Lloyd hit on a critical area of opportunity, and that's on the regulatory technology. You have to look no further than the fines that are being doled out in virtually every jurisdiction on KYC, AML infractions, and a lot of companies are dealing with antiquated technology and a tremendous number of human resources to comply with that jurisdiction's regulations, which may be nuanced from the next jurisdiction. So we think whether it's KYC, AML, geolocation, integrity solutions, there's a big opportunity there over time, and we don't see that going away.
So we've gone over a little bit, and I think that we're going to be ending up wrapping up, but I'm going to do a quick lightning round. You've got to boil it down to one subsector within this group that you feel like hasn't gotten enough attention over the course of the day-to-day listening to some of these. We'll go down the line. This is not part of the prep, but just off the top of your head, lightning round, go.
Live dealer.
Live dealer.
Personalization.
Personalization.
Blockchain.
Blockchain. Wild card.
Community.
Sweepstakes.
Excellent. Well, thank you all for joining us today. Hope to see you over the next day. Thank you, guys. Thank you.